The world of money and investment is rife with bizarre and startling truths. These are 15 of them and their associated teachings. Are you prepared to discover some mind-boggling truths about money, finance, and investing? Want to learn some fascinating facts? In this video, I reveal 15 shocking financial truths that will expand your understanding of the financial world. Prepare to test your knowledge today and learn something new. One of the finest long-term investments made by Warren Buffett first seemed to be a loser. In 1973, Buffett began purchasing shares of the Washington Post Company, now known as Graham Holdings Corporation, and ultimately paid $11 million. Buffett's interest in the Washington Post grew by more than 10,000% and was worth $1.4 billion by the end of 2007. Buffett's investment in the Washington Post was a resounding success. By all accounts, here's the catch. However, the stock price of the Washington Post plunged 20% following Buffett's investment and remained at that level for 3 years. Lesson: it takes time for good investments to bear fruit. Be patient. Number 2. According to orthodox financial theory, large stock market movements should not have occurred, but they have. In terms of US dollars, the Merval Index, Argentina's primary stock market benchmark, plunged a staggering 48% on August 12, 2019. It is a drop of 48%. In a single day, Charlie Bilello, an investor, described the decline as a 20+ sigma event. Mainstream finance theories are based on the assumption that price fluctuations in financial markets adhere to a normal distribution. The estimated age of the universe is 13.77 billion years to provide context. Lesson: the volatility of price fluctuations in the financial markets is substantially more than predicted by the theories. How, therefore, can we ensure our safety? Bilello stated it best: we must learn to anticipate the unexpected and be ready for different outcomes, with diversity being our best protection. A staggering amount of equities generate negative returns during their entire existence. JP Morgan revealed in 2014 that 40% of all stocks that have been included in the Russell 3000 index in the United States since 1980 had generated negative returns during their entire careers. JP Morgan defined lifetime as the period beginning when the firm initially discloses a stock price until its final reported price in 2014, or the day it was merged, purchased, or otherwise delisted. Implementing a robust investment framework that helps to screen out potential losers can have a significant impact on our investment results, given the large number of stocks that deliver losses to investors. John Maynard Keynes was a distinguished economist and professional investor. Inexplicably, his early years as a professional investor were terrible. David Chambers and Elroy Dimson wrote a paper titled John Maynard Keynes, Investment Innovator in 2013. It described the investment career of the late John Maynard Keynes from 1921 to 1946, when he managed the endowment fund of King's College, Cambridge University. Chambers and Dimson characterized Keynes' early investment technique as using monetary and economic data to mark time his flipping between shares, fixed income, and cash. Hence, Keynes attempted to time the market. He also fought. Between August 1922 and August 1929, Keynes' return lagged behind the British stock market by a total of 17.2%. Then, Keynes decided to change his investment strategy. He quit up attempting to timing the market and shifted his attention to studying businesses. This is how Keynes explained his latter approach to investing. As time goes on, I become more and more convinced that the best way to invest is to put relatively substantial sums into businesses one believes one understands something about and in whose management one has complete faith. Chambers and Dimson's research offered more context for Keynes' business-focused investment approach. Keynes felt that assets should be purchased based on their intrinsic worth, and he favored equities with high dividend yields. Keynes bought in a South African mining business because he held the management team in high respect and believed the shares was trading at a 30% discount to his assessment of the firm's breakup worth. What was Keynes' record overall? From 1921 through 1946, Keynes outperformed the British stock market by an annual average of 8 percentage points. When he attempted to timing the market, he failed badly, but when he began to invest based on business principles, he achieved phenomenal success. It is simpler to achieve investment success if you view equities as part of your businesses. Number 5. Straightforward investing methods are frequently superior to sophisticated ones. Investment manager Ben Carlson claimed in 2017 that the investment performance of American college endowment funds could not compete with the basic approach of investing in low-cost index funds. The top decile of college endowment funds in the United States achieved average annual returns of 5.4% for the decade ending in June 2016. Carlson outlined the investing strategy of college endowment funds in the United States as follows. These funds are invested in venture capital, private equity, infrastructure, private real estate, timber, the best hedge funds that money can buy. They have access to the best stock and bond fund managers. They use leverage. They invest in complex derivatives. They employ the most well-connected consultants. During the same 10-year period, a basic portfolio that Carlson dubbed the Bogle model generated a return of 6.0% each year. The Bogle model comprised of 3 straightforward, low-cost Vanguard funds: the Total U.S. Stock Market Index Fund, the Total International Stock Market Index Fund, and the Total Bond Market Index Fund. The Bogle model assigned corresponding weights of 40%, 20%, and 40% to each of these 3 funds. The lesson is that simple investment techniques may also be quite effective. Don't adopt a sophisticated plan just because it is complex. 6. Going against the crowd can result in physical pain. Naomi Eisenberger, Matthew Lieberman, and Kipling Williams conducted an experiment in which participants played a computer game while having their brains scanned. The participants were led to believe they were playing the game with 2 other individuals, while in reality, the other 2 were computers. After a period of 3-way play, the computers were trained to exclude the human player. During times of exclusion, human volunteers' brain scans revealed activity in the anterior cingulate cortex and insula. These are the regions of the brain that are active when we experience actual physical pain. James Montier, an investor, described that experiment in his book, The Little Book of Behavioral Investing, stating, "Being distinct from the majority is the investment equivalent of seeking out social suffering." Investing is difficult, particularly when going against the herd is necessary. Create preparations to overcome the obstacles. 7. The volatility of stock prices exceeds that of the underlying business fundamentals by a wide margin. The solid line represents the actual performance of the stock market, while the dotted line represents the reasonable performance. Notwithstanding the volatility of U.S. stock prices, the fundamentals of U.S. firms, as measured by dividends, were significantly less variable. Instead of focusing just on stock prices, we must consider the underlying company fundamentals. Traditionally, the longer you hold your stocks, the less likely you are to incur a loss. Based on Morgan Housel's analysis of stock market data from 1871 to 2012, if you keep equities for 2 months, you have a 60% probability of generating a profit. There is a 68% possibility of generating a positive return if the holding period is extended to a year. If the holding time is 20 years, there is a 100% possibility of profit. The following chart from Morgan demonstrates. Time on the market is your greatest ally. The market is seldom average. Robert Shiller's data indicate that the S&P 500 grew by 6.9% per year from 1871 to 2019. Incredibly, though, just 28 of these 148 years recorded a return between 0% and 10%. In actuality, there were 74 years with double-digit growth and 23 years with double-digit decrease. The graph below displays the frequency of S&P 500 calendar year returns from 1871 to 2019. Lesson: market returns are rarely typical, therefore you should not expect an average return in any given year. Even if the market has generated a significant return over the past year, you shouldn't be shocked and should exit the market. Short-term ownership of stocks with outstanding long-term profits can be agonizing. From 1995 to 2015, Monster Beverage, a publicly traded company in the United States, earned a total return of 105,000% on its shares, converting every $1,000 into more than $1 million. 4 times, Monster Beverage's stock price had fallen by at least 50% from its all-time high. From 1997 to 2018, Amazon.com's annual peak-to-trough decrease varied from 12.6% to 83.0%, indicating that Amazon's stock price saw a double-digit peak-to-trough loss every year. Over the same time frame, Amazon's stock price rose from $1.96 to $1,501.97, an astounding increase of almost 76,000%. Lesson: stock market volatility is a feature, not a flaw. It is simpler to make long-term stock market predictions than short-term ones. The 2 charts above display S&P 500 statistics from 1871 to 2013. They depict the returns of the S&P 500 relative to its initial valuation for holding periods of 1 year and 10 years. The stock market is a coin flip with a 1-year holding period. Low-priced equities may fall just as readily as they can climb, and the same is true for high-priced ones. Nevertheless, a distinct image appears when the holding time is extended to 10 years. When opposed to when they are pricey, stocks tend to provide larger returns when they are inexpensive. Lesson: invest with a long-time horizon, since we can create more accurate forecasts and so enhance our likelihood of success. Even if they invest in the best fund, investors may incur losses. In the decade ending 30th of November 2009, the CGM Focus Fund in the United States grew by 18.2% yearly. Regrettably, investors in the fund lost 11% each year throughout the same period. How? Investors in the CGM Focus Fund pursued performance and fled at the first sign of difficulty. Lesson: market timing is a fool's errand. Making money through currency trading is exceedingly tough. Consider the Autorité des Marchés Financiers to be the French equivalent of Singapore's monetary authority. The AMF released a research on individual forex trading in 2014. It analyzed the performance of 14,799 individual forex traders during a 4-year observation period from 2009 to 2012 and discovered astounding facts. Why 89% of traders lost money. The average loss per trader was 10,887 euros. The overall loss for roughly 15,000 traders exceeded 161 million euros. Lesson: currency trading may be a faster method to lose money than setting cash on fire. Extreme intellect is not a prerequisite for investment success. Long-term capital management employed a large number of PhDs as well as 2 Nobel Prize winners, Myron Scholes and Robert Merton. Even Warren Buffett remarked, "If you take the 16 of them, they probably have the highest average intelligence of any 16 people working together in a single firm in the country, including Microsoft or anybody you want to name." LTCM began operations in February 1994. A few years later, the company ceased operations. In September 1998, a dollar invested in the fund in February 2014 was worth only 30 cents. Professor of Finance at the Massachusetts Institute of Technology, Andrew Lo, established his own investment firm in the United States in 2009. Since the global financial crisis began a few years prior, several of the world's largest stock markets reached their lowest point in 2009. The value of Lo's investment portfolio increased by 15% in 2010, but then declined by 2.7% in 2011, 7.7% in 2012, and 8.7% in 2013. The fund closed in 2014. The S&P 500 in the United States roughly doubled from 2009 and 2013. The book The Search for Alpha, The Holy Grail of Investing by Larry Swedroe highlighted the performance of Mensa's investing club in the United States. Mensa members have IQs inside the top 2% of the world's population. In the 15 years ending in 2001, the S&P 500 averaged an annual return of almost 15%, whereas Mensa's American Investing Club returned only 2.5% annually. Buffett once observed, "You do not need to become a rocket scientist. Investing is not a game in which the one with the higher intellect wins." It is more vital to have the proper investing framework and emotional control than it is to be extremely intelligent. Even if the prices of the linked commodities increase, the stock price of a firm that trades in commodities might drop significantly. By the end of September 2005, 1 ounce of gold cost 620 Australian dollars. On September 15, 2015, the price of gold has increased by 10% annually for over 10 years, reaching a 1,550 Australian dollars per ounce. The S&P/ASX All Ordinaries Gold Index, an index of gold mining equities on the Australian Stock Exchange, decreased by 4% per year from 3,372 points to 2,234 points over the same time period. In 2015, oil prices began plummeting precipitously. On February 11, 2016, WTI crude achieved its lower price of $26.61 per barrel. By December 21, 2016, 10 months later, the price had quadrupled to $53.53. Over the same time period, the stock prices of 34 of 50 Singapore-listed oil and gas businesses declined, with an average decrease of 11.9%. The distance between a favorable macroeconomic event and the price movement of a stock can be a mile. If you like this video and want to know more, please make sure to subscribe to our channel and please hit the notification bell.